Hey, Scott. Welcome back to Riyadh, and it's great to have you for the first time in the FII conference. So we'd love to kick off this conversation with asking you, I know this is year 21 for Tiger, and you've been a truly global platform. What do you think have made you successful in being truly global?
Hani, thank you for having me here. Much appreciated. Well, the first is that we were early to identify that internet companies had very unique characteristics that made for great fundamental investments. And they had three things that were unique relative to what we had looked at before. They could grow at a high rate for a long time because you had penetration rates, and still have, going from sometimes below 1% of a market to, in the case of online music, something like more than half the market is now online. So penetration growth that could lead to revenue growth for a long time, high incremental profit margins, and if you could find them early enough, you could invest at low multiples of net profits. So the first was the internet. The second was the idea to look for private companies as a way to be able to buy bigger stakes in the best companies for a smaller amount of money. And then the third was to look globally. And so the first investments that we started doing research on were based in China, both public and private, in the internet, back in 2002 and 2003. And then over the course of years, we looked at companies in Russia, Latin America, India, Southeast Asia, and the region. And so those are some of the factors that have helped contribute.
Oh, fantastic. Thank you, Scott. So a very relevant question for today. You've been investing for 20 years through different cycles, including the aftermath of the dot-com, the global financial crisis. How would you compare today's venture environment to the previous down markets?
The internet is not broken. This year, I think Google and Microsoft each are going to generate somewhere between $60 and $70 billion of free cash flow. 60 or 70 billion. And Google went public, I think it was 15 or 16-ish years ago, for a $40 billion market cap. So Google went public at less than 1 times net profit. It was a value investment, one of the best available then. And so the internet's not broken. We're continuing to see high revenue growth, high incremental profit margins, and if you can invest in leaders. What has changed is there are a lot more eyes on the internet than there were 20 years ago. And during periods like this, it's great that something like 700 billion of capital went into market-leading private internet companies over the last couple of years. Cost of capital is up. Growth is absolutely continuing at high rates, and companies are definitely making sure that their expense bases are where they need to be so that they won't have to raise capital until they'd like to.
Got it. And throughout those same years, you invested specifically heavily in specific themes, like especially e-commerce themes and consumer markets, or consumer marketplaces. This included ride-hailing, food delivery, and e-commerce fulfillment. I'm really curious, how do you decide as a shop to close up on a specific investment theme? When do you set the time, to move on from that theme?
Penetration rates. The hallmark of most of our biggest winners has been when we identified a large market that the internet made better. Like the internet made it better, faster, cheaper, using computer science engineers and great leadership. And to try to find those markets when penetration was below 2%. And where a market that over the next 5 or 7 years, penetration would go to more than 20, 2 to 20. And then before you've gained market share, before the market has grown, revenue's up 10x. And now then if the market grows and a company gains share, you can have revenue that grows 20x, 50x, 100 plus x. And the best way to get into a company at a cheap multiple of cash flow is that type of growth. When we're typically looking to close up shop and go try to find the next great opportunity is when penetration rates start to rise. Once penetration hits 10% of a market, we've had some very nice successes, but it's just more difficult. And so we're really looking for those low penetration opportunities that in big markets.
So I'm very curious, like the last 10 years, I mean, one can characterize them as the era of like fast money, skyrocket high valuation, quick deals. I mean, today's market is nothing like that. So many like market headwinds. From your exposure to your portfolio companies, how do you see the leading companies behaving in these markets?
So I'm really grateful, and I think these stats are right. We own 2 to 4% of 6 of the 7 most valuable private internet companies today. I think the 7 most valuable private internet companies are ByteDance, Sheen, Stripe, Flipkart, Databricks, Canva, which we're not a shareholder of, because I screwed up, and it's a wonderful team and company, and we had a chance to invest a few years ago, and we didn't. Did I mention that we're not perfect? Oh, and we do make mistakes, many varieties. And then Checkout. And what we're observing is continued high growth, and many of those companies are profitable. There are several private internet companies today that generate more than $1 billion of net profit to today, not projections. And so from the largest, most valuable private internet companies, nothing's changing in the current environment because they have a sustainable business that is profitable or fully funded. There are companies that are earlier in their journey and expenses are higher than revenue. And for those, this environment absolutely is different. And one of the great parts about internet companies, and it was why we started investing in it a long time ago, is a lot of cost. I mean, unless you're like an Amazon or Flipkart or JD where you have high variable expenses, the hallmark of great internet companies is that most of the expenses are fixed. And during a period like this, you make sure that your expenses are right around or below revenue. And that has involved companies doing layoffs that have more cost than they can bear. And so it's a different environment but a healthy one, where capital is respected and companies that don't have to raise, or companies would like to extend the time horizon until they need to raise capital again. And very similar to what we saw, when we got started in 2000 on the private side in 2003 and 4 and 5, it was a great opportunity to identify great companies and be able to become a shareholder at a great price. And the same thing was true in 2009 and 10 after the recession.
So Scott, since we have you here, like we have to ask you about the region. I mean, over the last few years, we've seen you like committing to funds. We're investing in startups in different countries in the region. Would love to hear your view on the markets in MENA and Saudi.
It's a thriving ecosystem. And in particular, so the 3 categories that have been something like mid to high 90% of where we've ever invested are software companies, fintechs, and consumer internet. And in particular, what we're seeing in the region is really great innovation, great founders, and starting to be some big numbers like revenue, gross profit, and in 1 or 2 cases, net profit from companies that have been able to innovate. The first success we had was a company called Souk, which is in e-commerce and logistics and fulfillment. It got bought by Amazon, which was an awesome outcome for us and for the company. We're seeing a lot of innovation in software, logistics businesses, B2B marketplaces that help companies procure. And as we all know, it's a great, thriving region. There's a lot of financial institutions, and there's a lot of software and innovation being built to help them know their customers better and make more money. So tons of innovation. And the ecosystem, what we've seen is once you have businesses that are sustainable, well, an ecosystem develops. And you have amazing seed funds and incubation platforms and investors that focus on early stage companies that can sustainably identify great businesses, and have them reach a profit and ultimately generate a return.
Scott, thank you so much. Have a safe trip back to Miami. Sorry, Palm Beach. So, great to have you.
Awesome. Thank you for having me. Really
Thank you.
appreciate it.
Appreciate it.
And thank you all for
At
being
the
here.
stage, they told